So now we start off with an introduction to economic analysis. So what are some economic indicators? Well, we've got the GDP, the gross domestic product, the PPI, the producer price index, the CPI, the inflation rate, the real interest rate, the money supply, exchange rates, budget deficits, national debt, etc. But now let's take a look at the criteria we use for judging the performance of a country. Well, we have economic growth, full employment, price stability, balance of payment stability, and an equitable distribution of income. Now let's take a look at the different sources of economic data. So in terms of South African sources, we've got the South African Reserve Bank, and from there we have the quarterly bulletin, the annual economic report, and the monthly release of selected data. And then we have Stats SA. Here we get data on economic growth, data on employment and unemployment, and data on inflation. And then we get to the National Treasury, and here we have the budget review. Then we have the Development Bank. Then we also have the financial press, so we have FinWeek, Fin24, and Business Day. And then in terms of international data sources, we have the IMF, the International Monetary Fund. And here we get international financial statistics, government finance statistics, and balance of payment statistics. And then we move on to the World Bank, and here we get the World Development Report. And then we move on to the United Nations, and here we have the Human Development Report. Then we also have The Economist. But now let's take a look at some basic requirements and hence to be kept in mind when interpreting economic data. Well, you should always be acquainted with the definitions of the indicators. You should determine to which period the data relates. With weekly, monthly, or quarterly data, always check whether the data are seasonally adjusted. Always check whether the variable in question is a stock or a flow. Ascertain the geographical coverage of the data. Check whether the data has been adjusted for inflation. Check who produced the data and how the data were obtained. For example, whether it was from a government agency, market research company, or private researcher. You should know that correlation doesn't imply causation, and you should be careful when making international comparisons. Definitions may differ between countries, and valuations in different domestic currencies may also cause problems. So just some basic formulas you should know. The rate of inflation is equal to CPI new, the new consumer price index, minus CPI old divided by CPI old multiplied by 100. And then the GDP deflator is equal to the nominal GDP, so the GDP at current prices, divided by the real GDP, so the GDP at constant prices, multiplied by 100. And then the price index is equal to the CPI new, or the CPI in a given year, divided by the CPI base in a base year. And then the real GDP is equal to the nominal GDP divided by the price index. You should know that value is equal to the price multiplied by the volume or quantity. The nominal value is equal to the price times the quantity, and the real value is equal to the price times the quantity divided by the price. Now let's take a look at percentages versus percentage points. For example, if the price increased from 20 Rand to 25 Rand, that is a 25% increase. But if an interest rate increased from 10% to 11%, saying it's a 1% increase is incorrect. An interest rate increasing from 10% to 11% is a 1 percentage point increase, thus a 10% increase. So the formula would be the new interest rate minus the old interest rate divided by the old interest rate in absolute terms multiplied by 100. And that'll give you the 10% increase. So in that same vein, if the inflation rate increases from 5% to 7%, it increased by 2 percentage points, but it actually increased by 40% in absolute terms. And again, you should know that stocks have no time dimension and are measured at a particular point in time. For example, capital, money stock, balance on savings account, wealth, etc. And then flows are measured over a period of time. For example, investment, production, income, consumption, and saving, etc. And then ratios can be calculated between two stocks or two flows and a combination of a flow and a stock. So if a ratio is between two stocks or two flows, there's no time dimension. And an example of a flow and a stock could be production per worker. So production being a flow and the amount of workers being a stock. And then we also have averages. So we have medians, simple averages, and means. We also have weighted averages for differing importance of variables. And then we also have moving averages, which are used to smooth erratic movements in time series to get a general trend. Now we move on to chapter 2 with the national accounts. So the National Income and Production Accounts, NIPA, is made up of 4 accounts. So account 1 has GDP and Expenditure, account 2 has National Disposable Income and Appropriation, account 3 has Gross Capital Formation and Financing, and account 4 has transactions with the rest of the world. So, but what is the economic circuit? Well, this is the identification of the relevant economic subjects, objects, and processes or functions in the economic system. Economic subjects are households, businesses, government, and the rest of the world. Economic objects are goods and services produced in the economy. Processes include production, savings, investment, consumption, taxation, government expenditure, and foreign trade, so exports and imports. And the principal objective of the national accounts is the summation of the value of production of final goods and services in the economy. So the total or aggregate value of national production in monetary terms. So TE should be identical to TP. So total expenditure should be equal to or identical to total production. And that's the identity describing the demand side. And then TR is equal to or identical to TP. So total revenue should be equal to or identical to total production. And this is the identity describing the supply side. And you should know that the national accounts are based on the principle of double entry. So for every debit entry, there's a corresponding credit entry. So there are two types of transactions. So we have flow transactions, so income and expenditure. And then we also have transactions of change in assets and liabilities. And these two transactions are interdependent. So there are three ways of measuring GDP: the income approach, the expenditure approach, and the production approach. So in terms of GDP using the income approach, this is measured by adding up all the income received by the four factors of production. So rent, interest, profit, wages, etc. So the GDP at market prices using the income approach is equal to the compensation of employees, salaries or wages, plus net operating surplus, which includes the rent, interest, profits, owner's income, etc., plus depreciation or consumption of fixed capital. And at that point we get the GDP at factor costs. But at that point we add the production and product taxes, then we subtract the production or product subsidies, and then we get the GDP at market prices. Now let's take a look at GDP using the production method. Well, GDP using the production method is the sum of all gross value added, or the GDP at factor cost, plus product taxes minus subsidies, which gives you the GDP at market prices. And then in terms of GDP using the expenditure method, this is the sum of total expenditure on finished or final goods and services produced in the economy. And the formula is Y equals to C plus I plus G plus X minus M, plus the changes in inventories plus the residual item. So the GDP at market prices is equal to the consumption expenditure by households, plus investment, plus government expenditure, plus net exports, plus the changes in inventory, plus the residual item. Now let's take a look at account 1, gross domestic product and expenditure. So on the left hand side you'll have the supply, so income or production. Then on the right hand side you'll have final demand or expenditure. So starting on the left hand side, we first have the compensation of employees, and then we add the net operating surplus, and then we add the consumption of fixed capital or depreciation. After adding all these figures, we get the gross value added at factor cost. Now from the gross value added at factor cost, we add the taxes on production, and then we subtract the other subsidies on production. And then we get the gross value added at basic prices. Then from there we add the taxes on products or imports, then we subtract the subsidies on products or imports. And then finally we get the gross domestic product at market prices. Now on the right hand side of account 1, we start with the final consumption expenditure by households, so C, and then we add the final consumption expenditure by the general government, and then we add the gross fixed capital formation, so I fix, and then we add the changes in inventories as well as the residual item. Now after adding all this up, we get the gross domestic expenditure, so GDE, and from that we add exports of goods and services, and then we subtract imports of goods and services. And then finally we get the expenditure on gross domestic product at market prices. And you should know that the total for the left hand side should be equal to the total for the right hand side. And you should know that taxes on products are taxes payable per unit of the product or service. So this could be value added taxes, so VAT, taxes and duties on imports, and taxes on exports, etc. And then subsidies on products are subsidies payable per unit exported. And this is to encourage exports. And we also have product-linked subsidies on domestic products to encourage domestic use of these products or provide relief to low-income earners. Other taxes on production could be all remaining taxes excluding taxes on products. So this could be payroll taxes, business and professional licenses, stamp taxes, taxes on international transactions, recurring taxes on land and buildings and other structures, taxes on the use of fixed assets, and taxes on pollution. Other subsidies on production could be subsidies on the payroll or workforce, or subsidies paid to firms to reduce pollution. So you should remember the gross operating surplus is equal to the net operating surplus plus the consumption of fixed capital. So the consumption of fixed capital, or the provision for depreciation, is part of the gross product that's used to replace the fixed capital consumed in the production processes. So you should know there are two types of final consumption expenditure by the general government recorded in the national accounts. So first we have individual consumption expenditure. And this is government expenditure on individual consumption goods and services such as education, health, and welfare. And then we have collective consumption expenditure. So this is government spending on collective consumption goods and services like defense, law and order, public administration, etc. Now let's take a look at calculating the three types of GDP. So first we've got the GDP at market prices using the expenditure approach. So the GDP at market prices is equal to C plus I plus G plus XN. So consumption by households, investment, government spending, and net exports. And then we get the GDP at basic prices using the production approach. So here the GDP at basic prices is equal to the GDP at market prices minus taxes on products plus subsidies on products. And then we look at the GDP at factor cost using the income approach. Here the GDP at factor cost is equal to the GDP at market prices minus other taxes in production plus subsidies on production and imports. Now let's take a closer look at account 2, the gross national disposable income and appropriation account. So in this account we convert the gross domestic product into the gross national income. And we do this in order to determine the income that accrues and is available for South African citizens. So essentially, we exclude all income that accrues to foreign production factors. And we can do this to determine the level of welfare in a country. And you should remember that the net figures reflect the net result of payments of compensation to the rest of the world and payments of other factor income to the rest of the world. These two items combined represent the value of the net primary income payments to the rest of the world. So in account 2, on the left-hand side, you'll have the appropriation, and on the right-hand side, you'll have the income. So starting on the left-hand side, you'll have the final consumption expenditure by households, so C. And then we add the final consumption expenditure by the general government, so G. And you should remember that both of these figures were taken from account 1 on the right-hand side. So once we add the C and the G, we get the total final consumption expenditure. And then under that, we add the gross saving. And we get that figure from account 3, with the gross saving being the net saving plus consumption of fixed capital. And then finally, we get the appropriation of disposable income. And then on the right-hand side, we start with the compensation of employees. And remember, we got that from account 1. And then we subtract the net payments of compensation to non-residents. And then we get the national compensation of residents. And then we plug in the gross operating surplus. We don't add it, we just plug it in there. And remember, the gross operating surplus is the net operating surplus plus the consumption of fixed capital. And this is stuff we got from account 1. And from the gross operating surplus, we subtract the net payments of property income to the rest of the world. And then finally, we get the gross national operating surplus. And then after adding the national compensation of residents and the gross national operating surplus, we get the gross national income at factor cost. You could also get the gross national income at factor cost by adding up all these individual items without having to calculate the national compensation of residents or the gross national operating surplus. And so from the gross national income at factor cost, we add taxes on production and imports. And remember, we get this from account 1, and the taxes on products are synonymous with taxes on imports. So products and imports are the same. And then we subtract the subsidies on production and imports. And then from there, we get the gross national income at market prices. And then from there, you either add or subtract net current transfers from the rest of the world. So this could either be a negative or a positive figure. And then from there, we subtract the residual item, which is also in account 1. And then finally, we get the gross national disposable income. And again, the left-hand side total should be equal to the right-hand side total. Now we move on to account 3, the gross capital formation and financing thereof account. So this reflects the size and forms of capital formation and its sources of financing. And you should know capital formation includes both private and public expenditure on capital goods. It consists of gross fixed capital formation, so residential, non-residential buildings, construction, transport equipment, machinery, and other production goods, and change in inventory, so unsold goods and services, raw materials, and work-in-process goods. And you should know that net corporate saving is the difference between the total current income and expenditure of incorporated business enterprises. And then total private saving is savings by households plus corporate saving. So this is the sum of savings by households and companies. And again, the consumption of fixed capital or provision for depreciation is the amount set aside to replace capital equipment which is used up in the production process. And then the net capital formation is the gross capital formation minus the consumption of fixed capital. And then net saving is equal to the gross saving minus the consumption of fixed capital. And then another way to calculate the gross saving is the gross national disposable income minus the total final consumption expenditure. Now let's take a look at some of the external sources of financing capital formation. Well, first, this could be a net capital inflow from the rest of the world, and also a net increase in gold and other foreign reserves, which is reflected as a negative figure in account 3 and vice versa. So a negative sign in account 3 for gold and other foreign reserves means it's an increase in gold and foreign reserves. But a positive sign for gold and other foreign reserves denotes a decrease in gold and foreign reserves in account 3. So looking at account 3, we have outlays on the left-hand side and saving on the right-hand side. So starting on the left-hand side, we have gross fixed capital formation at the top. And remember, we also have this figure in account 1. And from there, we add change in inventories. And then finally, after adding those together, we get gross capital formation as a total at the bottom. Now on the right-hand side, we start off with personal saving, and then we add corporate saving, and then we add saving of the general government. If the figures are negative, it means there's dis-saving. And so after adding the savings of households, companies, and the government, we get net saving. Now from the net saving, we add the consumption of fixed capital, which is also in account 1, and then we get the gross saving. So the gross saving is the net saving plus the consumption of fixed capital. And then from the gross saving, we add the net capital movements from the rest of the world, and we also add the change in gold and other foreign reserves. In this case, the figure is a positive, which means that there's a decrease in gold and foreign reserves, meaning there's more money in the economy because of this decrease in gold and foreign reserves. And then finally, we get the financing of gross capital formation. And as usual, the left-hand side should be equal to the right-hand side. And so another way of calculating the gross capital formation is that gross capital formation is equal to gross saving plus net capital movement from the rest of the world plus changes in gold and other foreign reserves. And you should know during 2023, gross saving was supplemented by foreign reserves, so net capital inflows, and decreases in gold and other foreign reserves. Now we move on to account 4, transactions with the rest of the world. So this is the consolidated account of the balance of payments. It records transactions between South Africa and the rest of the world. And we have the receipts on the left-hand side and payments on the right-hand side. So on the left-hand side with receipts, we start with the exports of goods and services. And again, we can get this figure from account 1 also. From there, we add the primary or factor income receipts. And then we add the net current transfer receipts from the rest of the world. This could be negative or positive. And we can also find this in account 2. After adding that, we get the current receipts from the rest of the world. And from there, we add the balance on the current account, which could be positive or negative. And then finally, we get the receipts as a total on the bottom. Now on the right-hand side with payments, we start off with imports of goods and services. This is a figure we could also find on account 1. We then add the primary or factor income payments, and then we add the balance on the current account, which we could also find on account 3. And again, this figure could be positive or negative. And then after adding these up, we get the current payments to the rest of the world. From there, we add the net capital movements to the rest of the world, which could be positive or negative. And then we add the change in gold and other foreign reserves, which could be positive or negative. And then we finally get disbursements as a total on the bottom. And again, the left-hand side should be equal to the right-hand side. And you should remember, capital movements and the change in gold and other foreign reserves are recorded in both account 3 and account 4. And essentially, whatever sign they give you in account 3, it'll be the opposite in account 4. If the balance on the current account is negative, then it's probably a deficit. And if it's positive, it's a surplus. If the net current transfers to the rest of the world is negative, then it's actually a receipt. And if it's positive, then it's a payment. And then in terms of the change in inventories, this is essentially unsold goods and services. And if this figure is positive, it may mean that the economy is not doing well, even if there's increased capital. Or it may mean that the country is engaged in many capital projects. You should know that account 3 is usually compiled from the point of view of our economy, and account 4 is from the point of view of the Reserve Bank. Another thing to note is that South African capital flows are always positive in account 3, meaning that they're negative in account 4. You should also note that the expenditure on GDP, or the GDP at market prices, plus the imports minus exports gives you the gross domestic expenditure. And for account 4, the following identity holds. So the balance on the current account is equal to the net capital movements to the rest of the world, plus the changes in gold and other foreign reserves. And for a capital inflow is recorded as negative. So now we move on to the national financial account. So the National Financial Account is the systematic and meaningful recording of financial transactions between the different sectors of the economy. And this is done with the purpose of assisting policymakers in analyzing the financial position of the national economy as well as subsectors of the economy. And it's also known as the flow of funds account. It links financial flows to real economic activity. So in the account, the sources and uses of funds in every sector are shown in columns and transaction items are shown as rows. For example, the sectors you could find the foreign sector, the financial intermediaries, general government, business enterprises, etc. Then in the rows, the transaction items, you could get net saving, consumption of fixed capital, capital transfers, gold and other foreign reserves, etc. So the values for the transaction items or rows 5 and 6 will always be the same and should also have the same sign. So revolving around transaction item 5 and 6, we work from the bottom up and then the top down. So transaction item 5 is net lending or net borrowing. If the value for item 5 is positive, then it's net lending, and if it's negative, it's net borrowing. And the value for transaction item 5 is the difference between the sources and the uses for transaction items 1 to 4, going from the top down. Transaction item 6 is the net financial investment, which again could be positive or negative. The value for transaction item 6 is the difference between the financial assets and financial liabilities. So it's the difference between transaction item 8 and transaction item 7, which is essentially the sum of assets minus the sum of liabilities. And the values for transaction items 7 and 8, financial liabilities and financial assets, can be calculated by getting the sum of the transaction items 9 to 32. And this is going bottom up. And it should be noted that net lending or borrowing is a source and net financial investment is a use. And then financial liabilities are a source and financial assets are a use. So sources are net increases in liabilities at transaction value, and uses are net increases in assets at transaction value. So changes in liabilities are a source, for example, bank loans, long-term loans, and mortgage loans. And changes in assets are a use, for example, cash, demand deposits, short, medium, or long-term deposits, bills, stocks, shares, life and retirement fund contributions, etc. And you should know that a negative amount reflects a decrease in that item. In the case of liabilities, so sources, it denotes a reduction in the available sources of funds. And in the case of assets or uses, it indicates an additional source of funds. And again, the net lending or borrowing must always equal to the net financial investment. So now we move on to the balance of payments. So the balance of payments has 4 main sub-accounts: the current account, the capital transfer account, the financial account, and then the unrecorded transactions account. So in the current account, we have current and income transactions. So we have transactions in goods, transactions in services, transactions in factor or primary income, and current or unrequited transfers. And then we move on to the capital transfer account, and here we have transactions associated with the acquisition or disposal of fixed assets. And then we move on to the financial account, and here we have transactions in assets like shares, stocks, bonds, fixed property, and other financial transactions, for example, loans, liabilities. So this account only reflects identified capital movements. So anything that isn't identified won't be here. So in the financial account, we have direct investment, portfolio investment, financial derivatives, other investment, and reserve assets. And then we move on to the unrecorded transactions account. And this serves to balance the whole account in practice. And this includes transactions on the current, capital transfer, and financial accounts. So when looking at the balance of payments account holistically, we have credits on the left-hand side and debits on the right-hand side. Credits are a positive, so it's a receipt, and debits are a negative, so it's a payment. And within the current account, we have receipts of exports of goods and services, gold, income receipts, and current transfers, so net receipts. And then moving on to the debit side with the payments, we've got payments of imports of goods and services and income payments. And within the current account, we have a sub-account, the trade account, which just looks at exports and imports. Then we move down to the capital transfer account, and here we record the acquisition or disposal of fixed assets. Then we move to the financial account, and on the receipts, the credit side, we've got direct investments, we've got portfolio investment, financial derivatives, other investment, and reserve assets. And for all of these investments, if it's an inflow of this investment, it represents an increase in liabilities. And if it's an outflow of these investments, it represents an increase in assets. So South Africa's biggest trade partners include China, the US, and Germany. The main composition of South African foreign trade includes imports, so capital and intermediate goods, and exports, so mainly primary goods like mining and agricultural. And a measure of openness could be the exports plus the imports divided by the GDP, or the AVE, or measure of openness, is equal to the exports divided by the GDP, or the imports divided by the GDE, the gross domestic expenditure. And then the marginal import ratio is the change in imports divided by the change in output. And if this marginal import ratio is high, then it indicates a vulnerability to developments in the international sphere. But then what is the Open Market Index, OMI? Well, it measures the relative openness of major markets. The index was created for 75 countries and comprises more than 90% of international trade. And it was started in 2012 and is from the International Chamber of Commerce. So the Open Market Index, OMI, measures the observed openness to trade, trade policy, foreign direct investment, FDI openness, and infrastructure for trade. And then the terms of trade can be calculated as T is equal to PX divided by PM multiplied by 100. So it is the ratio between import and export prices multiplied by 100. And so the terms of trade are an indication of the volume or quantity of imported goods that can be obtained per unit of goods exported. And as the terms of trade increases, the overall economic welfare also increases. But now let's talk about exchange rates. So exchange rates are the price of one country's currency in terms of another country's currency. But now let's take a look at the methods of calculating exchange rates. Well, first we have the direct method, and this indicates how much of a domestic currency can be exchanged for 1 unit of foreign currency. So it's essentially the domestic price of the foreign currency, for example, $1 being equal to 18 Rand. And this is the most widely used method. And then we have the indirect method, and this indicates the foreign price of the domestic currency, for example, 1 Rand being equal to $0.08. And then in terms of quoted rates, we have the nominal rate and the multilateral rate. So the nominal rate is in monetary terms and it's bilateral, so between two countries. And then the multilateral rate is between more than two countries. And then appreciation is when the value of a currency increases relative to another currency. And then obviously depreciation is the opposite. Now let's take a look at spot and forward rates. So the spot rate is the rate at which the exchange is bought and sold for immediate delivery. And then the forward rate is the rate at which the exchange is bought and sold for delivery at a future date. But now let's take a look at nominal and real exchange rates. So the daily quoted exchange rates is equal to the nominal exchange rates. But then the real exchange rates can be calculated by taking the price movements into account. And this is done by adjusting the nominal rate by the ratio between South Africa and US prices. And so the real exchange rate, which is bilateral, is equal to the nominal exchange rate, which is an index, divided by the ratio between South Africa and US prices, so CPI in South Africa divided by the CPI in the USA, multiplied by 100. But then why do we calculate real rates? Well, if domestic prices rise faster than the foreign price, it'll negatively impact the competitiveness of the South African economy. If this effect isn't offset by an equal adjustment between the two currencies in real terms. And calculating real rates is also an indication of the over or undervaluation of the rand in real terms. If the real exchange rate index is above 100, it indicates an undervaluation of the rand and vice versa. And then effective exchange rates, which can be nominal or real, are multilateral exchange rates with the domestic currency weighted against a basket of other major currencies. So it uses different countries' shares in South Africa's foreign trade as weights. And there's currently 15 currencies in the basket and 85% of our trade is covered. And thus they're also known as trade-weighted exchange rates. And you should know both nominal and real exchange rates are bilateral exchange rates. So on a table you'll have the years, the exchange rate in monetary terms, the nominal exchange rate index, the ratio of South African to US prices, and then the real exchange rate index. The base year is 2010, so we'll be using the exchange rate in monetary terms for the year 2010 when doing calculations. So the nominal exchange rate index is equal to the exchange rate new, or the one that you want to calculate, divided by the exchange rate in a base year, multiplied by 100. And these are all exchange rates in monetary terms. And then the real exchange rate is equal to the nominal exchange rate that you calculated before, divided by the ratio between the US and South African prices. So CPI SA divided by CPI USA, so this price index, multiplied by 100. And when looking at the real exchange rate index on the table, you'll find that in 2011, the rand was overvalued as the index was less than 100. And this means that the rand appreciated against the US dollar. And then for all the other years after, the index was above 100, and this shows undervaluation of the rand. So the dollar remained overvalued against the rand, or the rand was undervalued against the US dollar, or the rand depreciated against the US dollar. So on average, the rand depreciated against the dollar in nominal terms between 2009 and 2018, except for 2010 and 2011. So the nominal exchange rates in column A and B indicate the prices of the dollar in rand terms. Therefore, an increase in the value or index indicates an appreciation of the dollar against the rand. And then a fall of the index would be an appreciation of the rand against the dollar. But then if the indirect method of quotation is used, it'd be the opposite. And you should remember, index numbers and exchange rates depend on the base year. The assumption is that the base value was calculated correctly. But now what's purchasing power parity, or PPP? Well, this is the number of units of one country's currency, for example rands, which endows the holder with the same purchasing power as one unit of the other country's currency, for example dollars. But then what is the absolute purchasing power parity? Well, this is the equilibrium exchange rate between two currencies. So it's the ratio between the price levels in two countries. For example, the same goods in South Africa cost more in the USA, with prices in both countries being expressed in dollars. So the rand is undervalued relative to the US dollar. For example, the Big Mac index. And then we have the relative PPP. Well, this takes changes in relative inflation rates into account. So it's the ratio of the equilibrium exchange rate in a current period relative to the equilibrium exchange rate in a base period. And it's the same method as calculating the real exchange rates, but the exchange rate isn't expressed as an index this time. So on a table, you'll have the year, the nominal exchange rate in monetary terms, then the CPI for South Africa and the US, and then the index or ratio between South African prices and US prices, and then the purchasing power parity exchange rate. But then how do we calculate the purchasing power exchange rate? Well, it's the ratio of South African and US prices, so CPI SA divided by CPI USA, multiplied by the nominal exchange rate in a base year, divided by 100. And so we compare the purchasing power exchange rate in column E, which is the ideal or equilibrium exchange rate, to the actual or nominal exchange rate in column A. And therefore, in every year except 2011, the rand was undervalued against the dollar, assuming the rand was valued correctly in 2010. Now we move on to supply and use tables, or SUTs. So the supply and use tables describe the whole economy by industry and by product. For example, the agricultural industry and sports goods products. The tables show links between the components of gross value added, GVA, industry inputs and outputs, and product supply and use. So the supply and use tables link different institutional sectors of the economy, for example households and firms, together, with details of imports and exports of goods and services, final consumption expenditure of government, and capital formation or investment. But now let's take a look at the supply table. So the supply table shows the supply of goods and services by the type of product and by the type of industry, distinguishing between the supply of domestic industries and imports of goods and services. So on the supply table, on the first column on the left-hand side, you'll have all the products listed. And then as you go along on the rows, you'll have all the output of the different industries. And then the sum of each column gives you the sum of output for each specific industry. And then the sum of the rows gives you the sum of each product. So one product could be produced by multiple industries, and multiple industries could produce more than one product. We also have a column for imports, and obviously the sum of this column gives you the sum of imports. Once you add the output of all industries and imports, you get the total supply at basic prices. Now from the total supply at basic prices, you have to add the trade and transport prices or margins, add the taxes on products, and then subtract subsidies on products, and then you'll get the total supply at purchasers' prices. So now we take a look at the use table, and this shows the use of goods and services by type of product and by the type of use. So essentially, intermediate consumption by industry, final consumption, gross capital formation, investment, or exports. The table also shows the components of gross value added by industry. So for the use table, on the first column on the left hand side, you'll have all the products and then the direct purchases from abroad. And then you'll have all the value added and then taxes and subsidies. And then finally the total output. And then in the columns following the products, you'll find the intermediate consumption of industries. And then you'll have another table adjacent to it which shows us the final use. So here you'll have the final consumption of households, final consumption of government, gross fixed capital formation, change in inventories, exports, and then you'll get the total final use. So the total final use is essentially equal to C plus G plus I plus X. And then the column after that is the total supply at purchasers' prices. Now you should note that the total supply at purchasers' prices in the supply table should be equal to the total supply at purchasers' prices in the use table. So you essentially just copy and paste those values. And then you should know that the total output of industries in the supply table should be equal to the total output in the use table. So this is the absolute bottom row in the same column as the intermediate consumption of industries. And we get this after adding the gross value added, the compensation of employees, taxes on production, other subsidies on production, and the operating surplus. Another thing you should note is that the total output of industries minus the total intermediate consumption of industries is equal to the gross value added. And you should know that the SUTs are given at basic prices, so we still have to adjust it to market prices. That's why we still have to add the trade and transport margins, taxes on products, and subtract the subsidies on products. And you should know that in the supply and use tables, we view the government as an industry producing government services. And so GDP can be estimated according to three approaches from the tables. So if we're using the production approach, GDP is equal to the total output minus the intermediate consumption plus taxes less subsidies on products. And then if we're using the expenditure approach, then GDP is equal to the final demand minus imports. And then if we're using the income approach, GDP is equal to the compensation of employees plus the gross operating surplus or mixed income plus taxes less subsidies on production, plus other taxes less subsidies on products. Now we move on to economic growth. So economic growth is the continuous expansion in the productive capacity of a country compared between two periods, and it's usually measured by GDP growth or GDP per capita growth. But then what is economic development? Well, this is the process and policies by which a nation improves the economic, political, and social well-being of its people. So it implies the growth and changes in the standards of living or well-being experienced by all citizens in the country. And then GDP measures the total value of economic activity within the geographic boundaries of a country. And it's a good measure to use if you're interested in production volume. And then GDP per capita includes population data and represents an average, not a distribution. And then the GNI or gross national income measures the total income of the residents of a country. It's a good measure if you're interested in the economic welfare of residents. GNI also accounts for terms of trade fluctuations. GDP, however, excludes imports, so if the prices of imports increase relative to the price of exports, it's not captured and growth is overestimated and vice versa. So the production possibilities frontier shows all possible combinations of products X and Y that can be produced within a country given the full employment of its resources. Short-term growth would be a movement from one point to the edge of the frontier. And then long-term economic growth would be an outward shift of the PPF curve. So short-term growth implies more production is taking place using the same amount of resources. Therefore, using resources more productively or better. Long-term growth implies the amount of resources has increased. So it's an increase in the productive capacity. And you should know long-term economic growth happens due to new technology, the division of labor, specialization, new production methods, increasing labor force, and new raw materials. But then how do we go about calculating real annual economic growth? Well, the formula is P new, or the new GDP, divided by the old GDP, or P old, to the power of F, which is the period, which could be quarterly, monthly, etc. If it's quarterly, you'll put a 4. If it's monthly, you'll put a 12. Minus 1, multiplied by 100. And obviously the real annual economic growth uses constant prices because it's real. You can also calculate the real headline quarter-on-quarter growth method using seasonally adjusted constant price data. So the quarterly GDP is compared to the immediately preceding quarter's GDP. We can also use the real quarterly year-on-year method using non-seasonally adjusted constant price data. So here the quarterly GDP is compared to the same quarter of the previous year. So that's what they mean with the real quarterly year-on-year method. And for both of these methods, the formula is the new GDP divided by the old GDP minus 1 multiplied by 100. And in this case, there's no period. So the GDP new divided by the GDP old is not to the power of f. We should know seasonal adjustments only impact quarterly GDP figures. Annual GDP total figures remain the same. But now how do we go about calculating average annual growth rates for periods spanning more than a year? Well, here the formula is yt divided by yt minus k to the power of 1 divided by k minus 1 minus 1 multiplied by 100. So it's the GDP of the latest year divided by the GDP of the oldest year, all to the power of 1 divided by k minus 1, where k is the number of years, periods, or intervals between the observations, all minus 1 multiplied by 100. And some important things to remember when calculating economic growth is regional GDP, constant prices, data revisions, avoiding business cycles, structural breaks, and seasonally adjusted data. If you calculate economic growth between a peak and a trough in the business cycle, it may underestimate or overestimate growth. And seasonal adjustment is necessary due to seasonal fluctuations in economic activity during a year. So due to weather, holidays, tax deadlines, pay cycles, etc. But now let's take a look at the percentage change formula. Well, the percentage change in variable a, so small a for example, is equal to a new minus a old divided by a old multiplied by 100. But then you should know the change in stock of a is equal to the percentage change in a, so small a, multiplied by big A, which is the stock of A at a point in time, divided by 100. So as an example, the GDP is equal to C plus I plus G. And from this we know that the change in GDP, or the change in stock of GDP, is equal to the change in C plus the change in I plus the change in G. So the change in consumption of households, change in investment, and change in government spending. And again, the change in stock of Y is equal to small y, so the percentage change in GDP, multiplied by Y, so the stock of GDP, divided by 100. But what if they ask, what is the change in GDP if the percentage change in government expenditure is 10%, everything else left unchanged? Well, the percentage change in GDP, small y, is equal to the share of consumption expenditure by households from GDP multiplied by the percentage change in consumption expenditure by households. So it's the share of C multiplied by the percentage change in C plus the share of investment in GDP multiplied by the percentage change in investment plus the share of government expenditure multiplied by the percentage change in government expenditure. Therefore, the percentage change in GDP is equal to the share-weighted sum of percentage changes. And so if you have the value of the GDP, for example 800,000, and the share of consumption, investment, and government expenditure, you can substitute these values into the formula and then you get a percentage. And then you finally substitute this percentage into the percentage change formula. So the change in y is equal to small y multiplied by y divided by 100. And this will show you how much GDP changes from a percentage change in government expenditure, investment, etc. But now we move on to inflation. So first, what is the CPI, the Consumer Price Index? Well, this is an index of a representative basket of consumer goods and services, and it measures cost of living. But what are some of the sub-indices of the CPI? Well, first we have the headline CPI, and this is the CPI for all urban areas. And then we have core inflation, which excludes VAT and property taxes and counts basic food products and loan costs. And there's a separate CPI for pensioners, and there are administered and regulated prices. So administered prices are prices that are consciously set by an individual producer or group of producers, and or any price which can be determined or influenced by government, either directly or through other government agencies without reference to market forces. For example, water and electricity prices, public hospital fees, petrol and TV licenses, etc. Then we have regulated prices. These are determined, monitored, or controlled by government policy. But now let's talk a bit about indexation. Well, this is making an index for a specific year. So for a basic index, it's the CPI in a given year, so the prices in a given year, divided by the CPI in a base year, multiplied by 100. But now let's take a look at the L'Espère's and the Posh index. So the L'Espère index is equal to the sum of the new prices multiplied by the old quantities, so PT multiplied by Q0, divided by the sum of the old prices multiplied by the old quantities, so P0 multiplied by Q0. So the L'Espère index holds quantities at the old or base period. And then the Posh index is equal to the sum of the new prices multiplied by the new quantities, so PT multiplied by QT, divided by the sum of the old prices multiplied by the new quantities, so P0 multiplied by QT. So the Posh index holds quantities at the current period. So when you get a question, it's important to identify which are the old quantities, which are the old prices, and which are the new prices, and which are the new quantities. But now let's talk a bit about technical shifting. Well, this is shifting the base period of an index to examine the movements in an index over a long period. For example, indices were calculated using 2012 as a base year, then the base year now changes to 2016, and then this time we'll use the indices to calculate the new indices using 2016's index as a base. So we use 2016's index and not its price. So initially 2012 is the base year and we'll calculate the index using prices. So we'll get the price of a given year divided by the price in 2012 multiplied by 100. But then if we make 2016 the new base year, we'll calculate the new index not using the prices but using the old index that we calculated with 2012 as a base year. So it'll be the index of a given year divided by the index in 2016 multiplied by 100. But then what is splicing or chaining? Well, it's a technique for linking two differently based indices, and it can only be done if the old and new series have at least one overlapping period, and it's similar to technical shifting. So here you'll get the old index figures divided by the new base index multiplied by 100, then you get the spliced index. So what are the types of indices? Well, we have a specific index, and this takes a single series and adjusts it so the values in the base year equal to 100. For example, maize production index, oil price index, etc. And then we have a general or composite index, and this contains a variety of variables, all adjusted so the base year is equal to 100. For example, industrial production, CPI, etc. And then you should know the price index is equal to the cost of the basket in a current period divided by the cost of the basket in the base period multiplied by 100. But then how do we go about constructing a composite or general index? Well, it has 5 steps, and the first step is the basket or regimen selection. And this depends on the relative significance of each potential item, and the CPI uses Stats SA's Income and Expenditure Survey and Living Conditions Survey with goods and services, etc. And then the second step is looking at the base period. So the reference point should be set to 100, and it should be in a recent, economically stable or normal period. And you should have a common base period for different indices. And then the third step is looking at the weights. So you assign a weight to each item according to the relative importance. So the weight could be, for example, equal to the proportion of income spent on the item or spending patterns, etc. And it should add up to 1 or 100, and you could use the Posh or the L'Espère or the Fisher methods. So you use the Posh method when comparing current values to the base period using current quantities. And then you use the L'Espère method when comparing current values to the base period using base period quantities. And then the Fisher method is the average of the Posh and L'Espère method. And then fourth is the collection of data. And this depends on the specific index, for example, food, tobacco, clothing, petrol prices, etc. And then fifth, we have the calculation. For example, for CPI, we could use the L'Espère index or fixed weights. But if we use the L'Espère, it may overstate price increases and understate price decreases, and it could be upward bias. But now let's take a look at the problems with the indices. While the L'Espère index numbers are upward bias, there could also be quality changes, new products, catalog prices versus actual prices, and custom-made goods. So the price index is an average and often conceals more than it reveals. But then how do we calculate the inflation rate? Well, the rate of inflation is equal to the CPI new minus the CPI old divided by the CPI old multiplied by 100. And it could be month on the same month of the previous year, and it can also be the annual average on annual average. For example, the average CPI in 2014, the new one, minus the average CPI in 2013, the old one, divided by the average CPI in 2013 multiplied by 100. But then the drawback of year-on-year inflation is the base effect. What happened a year ago has as much impact as what happened 1 month ago. And also, not all prices are measured every month, and this leads to stepwise movements. And you can also calculate the quarterly average on previous quarterly average inflation at an annual rate. And this is only significant when CPI figures have been seasonally adjusted. But now let's also take a look at implicit and explicit price deflators. Implicit price deflators could be the GDP deflator, and explicit price deflators could be the CPI or the PPI. So the GDP deflator can be calculated as the nominal GDP at current prices divided by the real GDP, so the GDP at constant prices, multiplied by 100. So we should know the PPI, the producer price index, and the CPI, the consumer price index, are both explicit price indices. The PPI estimates the cost of production, and VAT is excluded, and it includes capital and intermediate goods. And then the CPI estimates the cost of living, so VAT is included, and it includes consumer goods and services. So again, for implicit price deflators, the deflator is equal to current prices divided by constant prices multiplied by 100. The GDE deflator, the gross domestic expenditure deflator, has all final goods and services purchased in the economy, as opposed to the CPI's limited basket. And then the GDP deflator includes exports but excludes imports. Therefore, it reflects changes in prices of exports and not of imports. Then for the GNI deflator, terms of trade adjustments are made. Thus, it's a better measure than the GDP deflator. Now we move on to employment, wages, productivity, and income distribution. So the working age population is everyone in South Africa between the ages of 15 and 64. It's also everyone who should be working based on age and includes home workers, students, learners, and the physically disabled. And then the labor force or economically active population is everyone aged 15 to 64 who's willing and able to work. It's the sum of all the employed and unemployed people. It excludes home workers or home engineers, students, learners, and the physically disabled. And it excludes the discouraged workers and excludes the not economically active population. But then why do we care about employment? Well, it impacts directly on standard of living via income. It's an important development indicator, and it's an important economic performance criteria. But now how do we calculate the labor force participation rate? Well, the LFPR is equal to the labor force divided by the working age population multiplied by 100. But now what about the labor absorption rate? Well, this is the employed people divided by the working age population multiplied by 100. But now how do we calculate the employment coefficient or the production elasticity of employment? Well, this is equal to the percentage change in employment divided by the percentage change in GDP multiplied by 100. And this is for over more than 5 years. But now what is the marginal labor absorption capacity? Well, the labor absorption capacity in percentage is the increase in employment divided by the increase in the labor force or the economically active population multiplied by 100. But now what is unemployment? Well, we have the official or narrow definition and the unofficial or expanded definition. So the narrow definition of unemployment is someone who did not work 7 days prior, they're willing and available to work, and they have taken active steps to find work in the 4 weeks prior, or they have work or business to start at a specific date in the future. Now with the expanded definition, this includes discouraged workers. So it's people who didn't work 7 days prior and they're willing and available to work. And even if they haven't taken active steps to find work, they're still considered unemployed. And so the unemployment rate can be calculated as the unemployed people divided by the labor force multiplied by 100. And the labor force or economically active population is the employed people plus the unemployed people. And then the not economically active are the discouraged job seekers and the inactive ones. But then what is underemployment? Well, this is when you're not unemployed, but also not fully employed either. And so we've got visible underemployment and invisible underemployment. Visible underemployment is involuntarily working less than full time, so less than 35 hours per week. So this is part-time, casual, or seasonal workers that would prefer to be working full time. And so here employers try to avoid legislation or union problems by employing large numbers of part-time workers. So we have the casualization of the workforce. And then invisible underemployment is the misallocation of labor, for example, an economist working as a waiter, etc. And wages or compensation of employees is the largest component of gross value added at factor cost. So producers are a large component of production cost, workers enable consumption expenditure, determine the standard of living, then we also have labor unions. And you should know that we need to adjust nominal earnings in rands to real earnings, so purchasing power. And real wages can be expressed in monetary terms or in terms of an index. And nominal values are deflated by prices to obtain real values. So the real wage in monetary terms is equal to the nominal wage divided by the CPI multiplied by 100. And if we're going to look at indices, the nominal wage index is equal to the nominal wage divided by the nominal wage in a base year multiplied by 100. And then the real wage as an index is equal to the nominal wage index divided by the CPI multiplied by 100. Or it's the real wage divided by the real wage in a base year multiplied by 100. And then wage differentials deal with relative wages, how wages of individuals compare to others, for example, private versus public sector wage bills. But then what is the living wage? Well, this is the wage which an unskilled worker can use to satisfy an average-sized family's reasonable needs. And we have 3 poverty lines, so the food poverty line, the lower bound poverty line, and the upper bound poverty line. But then what is productivity? Well, productivity measures the amount of output produced by given amounts of factor inputs. So labor productivity is equal to Q divided by N, so output divided by the amount of labor. And then capital productivity is equal to Q divided by K, so output divided by capital. But these show partial productivity. We'd rather get the multi-factor productivity. And we can convert these into indices by dividing the productivity by the value in the base year multiplied by 100. But now let's talk a bit about the intensity of production. Well, if production is capital intensive, an increase in output will result in a proportionally small increase in labor. So essentially it's a small employment coefficient. So the capital intensity of production is equal to capital divided by output, and then the labor intensity of production is equal to labor divided by output. But now what is the unit labor cost, the ULC? Well, this is the average cost of producing 1 unit of output. So the ULC is equal to the nominal labor cost divided by output, Q, which is also equal to wages multiplied by labor divided by output. So W times N divided by Q. So if labor productivity rises as wages rises, then the ULC stays the same. But if a wage increase isn't matched by an increase in productivity, then the unit labor cost will increase and prices also rise. Therefore, the unit labor cost signals international competitiveness. But now let's take a quick look at the measures of income distribution or equality. Well, we have the Lorenz curve, the Gini coefficient, and quantile ratios. So the Lorenz curve shows the degree of income inequality by the deviation of the Lorenz curve from the diagonal, which represents perfect equality. And it's based on the relationship between the percentage of income which is owned by a percentage of the population. And then the Gini coefficient is a quantitative measure of the degree of income inequality, and it's obtained by dividing the Lorenz area of inequality by the bottom triangle. And if the Gini coefficient is equal to 0, then it's perfectly equal distribution. And if it's equal to 1, it's perfectly unequal distribution. And then the quantile ratio is the ratio between the highest X percentage and lowest Y percentage of the distribution. Higher ratios means higher inequality. Now we move on to business cycles. So the business cycle is fluctuations in aggregate economic activity, consisting of expansions followed by recessions, recovery phases, peaks, and troughs. This sequence is recurrent but not periodic over years, so it's 1 to 12 years. So on the y-axis you'll have the GDP growth, and on the x-axis you'll have the time. And on the graph you'll see peaks and then troughs and then expansions and then recessions, but the overall trend being upward. And we should know one complete business cycle is the time between 2 peaks or 2 troughs. But then what is the reference cycle? Well, this uses the full set of data, multiple individual series, describing economic activity. So it's not just GDP movements. It's essentially a business cycle, the full cycle in aggregate economic activity. And then a specific cycle is cyclical trends in individual series. For example, Y is equal to C plus I plus G plus XN. So specific cycles separate trends in Y, C, I, G, and XN. And then a reference cycle is a combination of seasonally adjusted trends in specific cycles. And then pro-cyclical deals with individual series. The policy moves with the business or reference cycle. And then counter-cyclical deals with individual series, and here the policy moves against the business or reference cycle. Then acyclical means it has no correlation with the business cycle, for example, weather conditions. So then how do we go about determining the reference cycle? The first method is the National Accounting Aggregate Method, for example, specific series. So you identify the cyclical component of the aggregate real GDP, and time series exhibits 4 types of trends. So we have the long run trend, TT, cycles, CT, seasonal variations, ST, and irregular variations, IT. So YT, GDP is equal to the product of TC, S, and I, or it's the sum of TC, S, and I. And then if we isolate the cyclical variation, CT is equal to YT divided by TSI, which is equal to TCSI divided by TSI. And then the second method is analyzing as many individual time series as possible. This is used by the South African Reserve Bank. So first you collect all available time series, seasonally adjusted, then you adjust for days in the month or price changes, and then you ensure compatibility for linking series, then you take the inverse form of some series, for example unemployment employment. And then for each individual series, you isolate the cyclical component, C, and determine the specific turning points. And then you assemble the turning points above into reference points using the following: diffusion indices, or a cluster of turning points. So diffusion indices measure distribution of changes in time series. And then the cluster of turning points is concentrations of peaks and troughs. And so the South African Reserve Bank uses a combination of the methods above to determine if a turning point has occurred. So first they have 3 composite business cycle indicators that are monitored continuously, so leading, coincident, and lagging indices. And if they indicate that a turning point has occurred, 2 comprehensive diffusion indices are calculated. So we have the historical diffusion model that shows the number of time series that are increasing relative to their time as a percentage of the total series. And if the value is above 50, it's an upward phase, and if the value is less than 50, it's a downswing. Then we have the current diffusion index. So this is calculated from actual month-on-month changes in each of the time series. So deviations of the index from its long-run trend indicate a cyclical movement. So then in terms of measuring the reference cycle or the business cycle, it represents important economic processes. It bears consistent historical relationship with the business cycle. It's not dominated by irregular and non-cyclical movements, and is reported promptly and frequently. Now let's take a look at the classification of the South African business cycle indicators. So first we have leading indicators, and these lead by more than or equal to 3 months. They're usually related to changes in demand, future production, and expenditure, and they're usually expected economic activities. Then we have coincident indicators. These are less than or equal to 2 months, leading or lagging, and they're usually related to real production and expenditure, employment, and production capacity. And then we have lagging indicators. These lag by more than or equal to 3 months, and this just confirms the business cycle changes. So some leading indicators could be the business confidence index, growth in leading indicators of major trading partners, residential building plans passed, and for example, a growth in the number of job ads in Sunday Times. And then coincident indicators could be the gross value added, formal non-agricultural employment, the industrial production index, and the value of new vehicle sales. And then some lagging indicators could be the value of non-residential buildings completed, cement sales, consumer credit to disposable income ratio, and the prime overdraft rate. But now let's take a look at composite business cycle indicators. So we have the composite leading index, and this leads peaks by 12 months and troughs by 4 months. And it predicts turning points and has 11 economic indicators. And then we have the composite coincident index. So this has a 0-month deviation from the reference cycle. This displays the intensity of the business cycle and has 5 economic indicators. Then we have the composite lagging index. And this lags peaks by 5 months and troughs by 7 months. And this confirms the observed business cycle and has 7 economic indicators. And then the other approaches to forecasting economic activity include single variable extrapolation, and this is good for short-term results. Then we have anticipation surveys, for example, the business confidence index. And then we have the consensus of observers approach, and these are the opinions of experts and forecasters. And then we have econometric models, so identities and functions fitted to historical data based on economic theory. Now we move on to fiscal indicators. So fiscal indicators provide an indication of government intervention in the economy, so essentially fiscal policy, and it's important for foreign investors, aid agencies, etc. And fiscal policy is outlined in the National Treasury's annual budget, but it shouldn't be analyzed in isolation. It affects micro-level politics, development, and poverty objectives. And we should know that national government departments plus social security funds gives us the national government, the main budget. And then if you add extra budgetary institutions like SABs and universities and technicons, then you get the central government. And once you add provincial governments and local governments or municipalities, you get the general government. And then once you add public business enterprises like Transnet, you get public authorities. Then once you add public corporations like Eskom, you get the public sector. But then what is fiscal policy? Well, these are efforts of the government to use changes in government expenditure, taxation, including transfers, and government borrowing to influence aggregate expenditure in order to influence income, production, prices, and the balance of payments. And the fiscal policy instruments are taxation, expenditure, and borrowing or debt. And we should know public debt is the cumulative result of government's past borrowing activities, so it's a stock variable. And so public debt, PD, is equal to all past borrowing minus repayments. So PD, public debt, is equal to G, government expenditure, minus T, tax revenue, plus the old public debt, plus the real interest rate multiplied by the old public debt, so the interest payments. And public debt is mainly financed domestically and has an increasing trend. Therefore, it's transferred from generation to generation. Rising interest payments cut into government expenditure that could be spent elsewhere. And so we calculate the public debt to GDP ratio as public debt PD divided by GDP. And we expect 50% for developing countries and 40% or less from a developed country. But then what are public sector borrowing requirements? So PSBR. Well, these are borrowing requirements of general government and public enterprises. It represents the projected net claim of the public sector on capital markets. Now let's take a look at government expenditure. So first we have current spending, and this includes remuneration of employees, goods and services, subsidies, social security, and interest on public debt. And you should know the remuneration of employees and goods and services are government consumption expenditure, and then subsidies, social security, and interest on public debt are transfer payments, so they don't contribute directly to output. And then we have capital spending, and this is fixed investment in infrastructure. And we like calculating the government expenditure to GDP ratio, so G over GDP. Capitalists say it should be less than 25% to avoid crowding out, and then Keynesians or socialists argue for 25% to 35% to make up for market imperfections. Next, we take a look at government revenue. So in terms of tax revenue, we have taxes on income and wealth. This includes personal income tax, corporate income tax, and capital gains tax. These are direct taxes. And then we have taxes on production and imports, so value-added tax, VAT, and customs and excise duties. And these are indirect taxes. Then we have other revenue from assets, etc. And here we'd calculate tax revenue T divided by GDP. And here 20 to 25% is suggested to maintain fiscal strength. And then we take a look at the budget deficit. So the conventional deficit D is equal to tax revenue T minus government expenditure G. And government expenditure is usually larger than tax revenue. Therefore, D is usually negative, so it's in deficit. And then the current deficit is equal to current tax revenue minus current government expenditure. And then the primary deficit is equal to aggregate tax revenue minus non-interest government expenditure. And deficits can indicate a government's objective, so growth stimulation or stunting. But now, what are the sources of financing? Well, there's domestic financing, so government bonds, etc., foreign borrowing, as well as seigniorage. And seigniorage is profit from the government issuing currency or printing money, and this isn't good. And here we like to calculate the debt to GDP ratio. And here less than 3% is suggested. And now we move on to financial indicators. So the financial indicators of interest to economists are money and credit, interest rates, and share prices. But then what is money? Well, this is the generally accepted payments for goods and services or clearing of debt, and it's a stock variable measured at the last day of every month. And it's a good indicator of the interest rate movements or price movements. But then what are the functions of money? Well, it's a medium of exchange, a store of value, and a unit of account. So then what is credit extension? Well, this is credit extended to the non-financial private sector. So it funds production, consumption, and capital formation, and is a link to future interest rate movements. And then what is the interest rate? Well, this is the amount of interest payable over a certain period as a percentage of the amount borrowed, and it's the price of money. So interest is the payment by the borrower to the lender for the use of funds. But now let's take a look at simple interest. Well, this is calculated on the principal sum, PV, only. So the interest payment, so I, would equal to the present value multiplied by the real interest rate multiplied by the number of years. And then let's take a look at compound interest. So this is calculated on the principal sum plus any interest due, which is added to the outstanding loan amount after each period. And it can be compounded at intervals shorter than 1 year. And in this case, the interest payment would be higher. So FV would be equal to PV multiplied by 1 plus R divided by N to the power of N multiplied by T. FV being the future value, N being the number of times per year that the interest is compounded, R being the interest rate, and T being the years. And when you calculate the present value of a stream of expected future investment or loan payments, that is discounting. But now let's take a look at interest rates. So the money market is for lending and borrowing short-term financial instruments, and the maturity is less than 6 months. And then we have the capital market for lending and borrowing long-term financial instruments. And here maturity is longer than 6 months. And it has 3 categories: bonds, shares, and negotiable documents. But what are determinants of interest rates? Well, it's uncertainty, inflation, risk, or credit rating of the borrower. But then what is the discount rate? Well, this is when securities are issued at a discount to their maturity value. And the discount rate is equal to the discount divided by the future value multiplied by 100. And then the interest rate or yield is equal to the discount divided by the present value multiplied by 100. And we should know 100 basis points is equal to 1 percentage point. So for example, 13.5% to 13.4% is a 10 basis point fall and not a 0.1% fall. And we should know the real interest rate is equal to the nominal interest rate minus inflation. And then what is the share price? Well, this is the price of a unit of a company's equity capital, giving the holder membership and voting rights in the company. And then market capitalization is the market value of a company's issued share capital. The PE ratio, or the price to earnings ratio, is the share price divided by the earnings or profit per share. If it's high, it means high growth, and if it's low, it means modest growth. And then the earnings yield, EY, is the earnings or profits divided by the price, so it's the inverse of the PE ratio. It's the net profits per share as a percentage of the price. And then the yield is the dividend per share, and it depends on a company's dividend policy. And now we move on to econometrics. So econometrics is the empirical estimation of economic relationships. It utilizes the following: economic theory as embodied in an econometric model, facts as summarized by relevant data, and statistical theory as refined in econometric techniques in order to measure and to test empirically certain relationships among economic variables. So then what is the purpose of econometrics? Well, first is structural analysis, using the estimated model for quantitative measurement of economic relationships, and then forecasting or extrapolation, using the estimated model to predict the quantitative values of certain variables outside the observed sample, and then we can use it for policy evaluation, using the estimated model to choose between alternative policies. Now let's take a look at the types of data. Well, first we have quantitative data, and this is numeric values, and these are immediately usable. And then we have qualitative data, for example, male or female, and these could be assigned numeric values. For example, gender is 1 for male and 0 for female, so a dummy variable. And then we have time series data. This measures a particular variable during successive time periods or at different dates. For example, daily, weekly, quarterly, or annually. And then we have cross-sectional data. This measures information for different individual economic agents. For example, different countries or different households, etc. at the same time period. For example, C equals to B0 plus B1 multiplied by Y. C being household expenditure, and this is the dependent variable. B0 being autonomous consumption, and this is the y-intercept when x is equal to 0. And then B1 is the slope or gradient, and this is the marginal propensity to consume, change in C divided by change in y. And then y is the total income, and this is the independent variable, or x. And so C is equal to Fy. So the variation in C may be explained by variation in y. But now let's take a look at the types of variables and causality. So the dependent variables are the ones being explained, and they're on the left of the equal sign. And then the independent variables are the ones that are used to explain, and they're on the right of the equal sign. So income causing consumption makes sense, but consumption causing income doesn't. And then an endogenous variable is explained by the model or theory. And then an exogenous variable is determined outside the system or model. They're used to explain the model but aren't explained by the model. And now let's take a look at the types of equations. So first we have identities, and these are always true. The variable is divided into its components. For example, the gross domestic expenditure being equal to C plus I plus G. And then we have definitions, and these are defined to hold true. For example, average cost being equal to the total cost divided by the quantity. And then we have institutional equations. These are determined by institutions of the economy through laws and regulations. For example, VAT being equal to 0.15 multiplied by the total income from sales. And then we have behavioral equations. This reflects hypotheses with regard to the behavior of economic agents. And then we finally have technical equations. These are determined by the state of technology. For example, output being equal to technology, capital, and labor. And now let's take a look at stochastic models. Here we mostly model human behavior. For example, sales is equal to B0 plus B1 multiplied by price plus E. So B0 plus B1 multiplied by the price is the deterministic component. And then E is the random or error term, or the stochastic disturbance term. And the stochastic error term is also necessary because of the following: measurement errors, omitted variables in specification, theoretical equations may have a different functional form, so nonlinear, or there may be random shocks that may alter behavior. And we only use the error term in behavioral and technical equations. And then in terms of dimensions, time series data would be, for example, sales at a point in time equal to B0 plus B1 multiplied by price at a point in time, so price T plus ET. And then for cross-section data, it would be sales I is equal to B0 plus B1 multiplied by price I plus EI. And then panel data would be a combination of the two. So sales IT is equal to B0 plus B1 multiplied by price IT plus EIT. Now let's take a look at the linear regression model. Well, this is a statistical technique that attempts to explain movements in one variable, the dependent one, as a function of movements in a set of other variables, the explanatory variables. So it's the classic y equals to B0 plus B1 multiplied by x plus ET. and the error term isn't measurable. So ET represents all the variation in y that can't be explained by the explanatory variables included in the model. And then m, or b1, the gradient, is equal to the change in y divided by the change in x, so y2 minus y1 divided by x2 minus x1. So the slope is constant for a linear model. This isn't the case for non-linear relationships. For example, y being equal to b0 plus b1 multiplied by x squared. But now let's talk about ordinary least squares, the OLS model. Well, this is a method to estimate the coefficients b0 and b1 in y equals to b0 plus b1 multiplied by x plus et. So the estimated equation is equal to y hat is equal to b0 hat plus b1 multiplied by x. And the difference between actual and estimated values, so the residual, which is ET, is equal to YT minus Y hat. So the OLS method minimizes the residual, and therefore minimizes the difference between the actual and estimated values. And so the estimated equation, Y hat is equal to B0 hat plus B1 hat multiplied by XT, has two important properties. So the first property is that the estimated and observed values can differ, but the sum of the difference between y and y hat must equal to 0. And then the second property is that the sum of squares of differences will be a minimum. So by minimizing the sum of y minus y hat squared, we can obtain the formulae and values for the coefficients b0 and b1. And we usually include variables in their natural log form because it tempers the data. So we use ln and not log. So we can estimate the elasticities instead of plain unit coefficients. And so log deals with percentages or ratios, so 46.5. And then level deals with units, for example 46,500. And so bivariate is where there's one y and one x. So you don't have to say ceteris paribus, but it's not wrong if you do mention it. And then multivariate is where there's one y and more than one x. For example, sales volume being explained better if we add explanatory variables like the price of the product, substitute price, income of clients, etc., and not just the advertising expenditure. So we'd use a multiple regression model. So here we'd have multiple b1s or k's. And remember, b0 is the value of y when all the x's and the error terms are 0. Now let's take a look at the classical assumptions of regression analysis. So if these assumptions hold, the OLS procedure is considered to be the best available. But when one or more of these assumptions don't hold, other estimation techniques may be better than OLS. And violations of the classical assumptions may lead to problems like multicollinearity, heteroscedasticity, and serial correlation, etc. So the first assumption is that the regression model is linear in the coefficients and the error term. Second is that the error term has a zero population mean. Third is that all explanatory variables are uncorrelated with the error term. Fourth is that observations of the error term are uncorrelated with each other, so there's no serial correlation. And then fifth is that the error term has a constant variance, so no heteroscedasticity. The sixth assumption is that no explanatory variables are a perfectly linear function of other explanatory variables, so there's no perfect multicollinearity. And then the seventh and last assumption is that the error term is normally distributed. But now let's take a look at the violations of the classical assumptions. Well, first is serial correlation, when the error term from one period depends on error terms from other periods. So positive serial correlation is when observations have a pattern, and then negative serial correlation would be the opposite of every observation, and then no serial correlation would be just spread out everywhere. And then the other violation is heteroscedasticity. So here we have different variances for errors across time. For example, the variance between observations increasing over time. And then we have multicollinearity. So here there's a linear relationship between two or more independent variables that's so strong that it can significantly affect the estimation of the equation. But now let's take a look at the difference between the economic evaluation and the statistical evaluation. So for the economic evaluation, for example, you'd have y is equal to 46.48 plus 52x. So here you comment on the slope. For example, an increase in x by 1,000 will lead to an increase in y by 52,600. And a positive sign for the m, or the gradient, means an increase in x will lead to an increase in y. And we don't usually evaluate the y-intercept when x is equal to 0. And then for the statistical evaluation, we take a look at standard errors and t-statistics, and these indicate the significance of parameters in the function. We also take a look at the different estimates of bs, so how does b hat compare to b? And the larger the standard error, the more the estimates will vary. And if we take a look at the t-statistic, the rule of thumb is that if the absolute t value of the coefficient bi is larger than 1.96, then the variable is significant. But if the absolute t value of the coefficient bi is less than 1.96, then you should drop the variable. And then what about r squared? Well, this is the proportion proportion of total variance explained by the regression. It's a measure of the explanatory power of the regression model, and it's between 0 and 1, so it's the degrees of freedom n minus 1. For example, if r squared is equal to 0.9, 90% of the variance in the dependent variable y is explained by variation in the independent variable x, ceteris paribus. But what if we have r squared and r bar squared, or the adjusted r squared? Well, each time a variable is added, r squared increases, so you'd rather use r bar squared. So r bar squared is adjusted for degrees of freedom. If r bar squared is close to 1, almost all the variation in the dependent variable y is explained by the independent variables, x's. And the rule of thumb here is that if the r squared or r bar squared is more than 0.7, it's acceptable for time series data. If it's a lower value, it's acceptable for cross-section data. And then we take a look at the f statistic. This tests the overall significance of the equation, so joint significance. If f is larger than 4, the coefficients are jointly significant. And then we take a look at the Durbin-Watson statistic, DW. So this tests for the existence of first-order serial correlation, and it ranges from 0 to 4. First-order serial correlation occurs when the e's, or the residuals or error terms, are correlated with each other. And the rule of thumb is that if dw is around 2, so between 1.5 and 2.5, it means there's no serial correlation. Values closer to 0 means there's positive serial correlation. And then values close to 4 means there's negative serial correlation. So just to summarize these statistics, multiple r indicates the correlation between x and y. R square and adjusted r square give you the fit of the model. How much variation in y is explained by x. The standard error is the average distance between the fitted and the actual values. The f statistic and the significance of f tells you about how good the model is overall. And you should know we want small standard errors. And you should know the t-stat and the p-value tells you how significant each variable is and not the overall model. That's the f-stat. And then the upper and lower 95% tells you that we're 95% sure our actual value will be between these values. The intercept is b0, and for example, advertising is b1 or x, or the independent variable. And if we had to interpret the results, we'd say that for each additional unit of ad expenditure, sales are expected to increase by 52.5 units. So the basic steps in regression analysis involve reviewing the literature, specifying the model and selecting the independent variables and the functional form, hypothesize the expected signs and magnitudes if possible of the coefficients, collect the data, estimate the equation, evaluate the equation, firstly according to economic criteria, and then according to statistical criteria, and then document the results.